The global financial system is a precarious house of cards, teetering on the foundations of the U.S. dollar, whose dominance has been both a boon and a curse for the international economy. This dominance, a relic of the Bretton Woods system established in the aftermath of World War II, has shaped the flow of money and trade for decades. But like all systems built on faith rather than intrinsic value, it is vulnerable to collapse. Understanding this system requires peeling back layers of complexity to see the hollow core beneath. Bretton Woods created a financial architecture where the U.S. dollar was pegged to gold, and other currencies were pegged to the dollar. This arrangement was marketed as a way to stabilize global trade and protect wealth. The U.S. effectively said to the world, "Hold dollars instead of gold. They're safer, easier to store, and always redeemable." For $35, any country holding U.S. dollars could exchange them for an ounce of gold, reinforcing the dollar's credibility. However, the system's inherent flaws became apparent as U.S. debt rose during the 1960s, driven by military spending and domestic programs. Foreign nations began to doubt America's ability to honor its promises, redeeming dollars for gold at an alarming rate. By 1971, President Nixon severed the dollar's gold convertibility, breaking the link between currency and tangible value. This act hollowed out the base of the monetary pyramid, leaving the dollar as fiat currency, valuable only because the U.S. government decrees it so, and the world has no better alternative for now. Since then, the dollar has remained the foundation of global trade and finance, not because of inherent strength, but due to the lack of a viable competitor. Countries might occasionally use other currencies, like the yuan or euro, in bilateral trade deals, but these are superficial changes. The system still gravitates back to the dollar because it underpins the global financial infrastructure. When China and Brazil agree to trade in yuan, for example, the yuan eventually gets converted back into dollars as the recipient nation seeks a currency that can be used widely in international markets. Escaping the dollar requires more than bypassing it. It demands an entirely different foundation. This is where gold and silver enter the conversation. Unlike fiat currencies, precious metals have intrinsic value rooted in their physical properties, scarcity, and historical role as money. For a trade to genuinely circumvent the dollar, it would need to be denominated directly in gold or silver, measured in ounces, not dollars. For instance, if a country trades oil for 100 ounces of gold instead of $100 million, only then is it truly outside the dollar shadow. But nations resist such a system because it lacks the convenience of fiat and the flexibility of inflationary policies. The modern financial system is a pyramid of debt, an ever-expanding structure requiring constant growth to remain stable. Governments, corporations, and individuals all operate on borrowed money, rolling over old debt into new, larger obligations. This cycle feeds itself, creating an exponential curve of debt growth. The system requires constant injections of new money, which central banks provide through mechanisms like quantitative easing, QE, and low interest rates. However, each injection dilutes the currency's value, sowing the seeds of inflation and instability. Eventually, this pyramid will reach a tipping point. One more financial crisis, a major bank failure, a geopolitical shock, or a debt default could push the Federal Reserve and other central banks to print trillions more, accelerating inflation to unsustainable levels. At that point, the public's faith in fiat currency may falter, triggering a rush into tangible assets like gold, silver, and even essential goods. This moment of reckoning is inevitable. History shows that no fiat currency survives indefinitely. The U.S. dollar has lasted longer than most because of its unique position as the world's reserve currency. But even this privileged status cannot shield it from the consequences of unchecked debt and monetary expansion. Hyperinflation is not just an economic phenomenon, it is a psychological shift. It occurs when people lose faith in a currency, rushing to exchange it for anything of real value. At first, this shift happens slowly, with informed investors moving into gold, silver, and other hard assets. But as inflation accelerates, the broader public begins to panic, buying anything they can to preserve their wealth. This leads to skyrocketing prices for goods, services, and real assets, creating a self-reinforcing cycle. Consider the example of the Israeli shekel in the 1980s. Hyperinflation rendered the old shekel worthless, forcing a reset to a new shekel to stabilize the economy. Such collapses are often dismissed as anomalies, but they illustrate a fundamental truth. Fiat currencies are only as strong as the public's belief in them. Once that belief erodes, collapse is inevitable. In the U.S., the seeds of hyperinflation have already been planted. The Federal Reserve's massive money printing during the COVID-19 pandemic flooded the economy with liquidity, creating a surplus of dollars chasing limited goods. While inflation has been tempered for now, another crisis could ignite it again, especially if the Fed is forced to cut interest rates to zero and restart QE to save struggling banks or corporations. In such an environment, the dollar's perceived value will deteriorate rapidly. Throughout history, gold and silver have been refugees in times of economic turmoil. Unlike fiat currencies, they cannot be printed or devalued by governments. Their scarcity and universal acceptance make them ideal stores of value. As the cracks in the financial system widen, savvy investors are already moving into these precious metals, anticipating their rise. The long-term trajectory for gold and silver is upward, driven by the system's underlying fragility. Some analysts predict gold could reach $50,000 or more per ounce if it were to fully back the U.S. dollar. While such estimates may seem extreme, they reflect the scale of monetary expansion and the amount of fiat currency that would need to be absorbed by tangible assets in a collapse scenario. For the average person, understanding this shift is crucial. Most people remain unaware of the system's vulnerabilities, trusting that central banks and governments will maintain stability. But when the crisis hits, the rush into gold, silver, and other real assets will be swift and chaotic. Those who prepare early will preserve their wealth. Those who wait will face the harsh realities of hyperinflation and economic collapse. The stock market's apparent strength is another illusion in this precarious system. While indices may rise, their gains are often outpaced by inflation, eroding real returns. Investors who focus solely on nominal gains may find themselves trapped as economic fundamentals catch up with financial markets. Eventually, the disconnect between market performance and economic reality will snap, leading to sharp declines. When this happens, the flight to real assets will intensify. Stocks, bonds, and fiat currencies will lose their appeal as investors seek tangible value in a collapsing system. The shift will not be gradual but sudden, driven by a collective realization that the current system is unsustainable. The key to navigating this transition is preparation. Those who understand the system's fragility are already positioning themselves, accumulating gold, silver, and other hard assets. For others, the awakening will be abrupt and painful. As the dollar's value erodes, the scramble for alternatives will create chaos, with prices for goods and assets soaring. This transition is not just an economic shift, but a philosophical one. It reflects a return to fundamentals, a rejection of the hollow promises of fiat currency in favor of tangible value. While the journey will be tumultuous, it offers an opportunity to rebuild the financial system on a more stable foundation. The lesson is clear: fake money cannot last forever. As the illusions of fiat currency unravel, the enduring appeal of gold and silver will shine brighter. Those who recognize this reality will weather the storm, while others are left to grapple with the consequences of ignoring history. In the end, the choice is simple: prepare now or face the fallout of a collapsing system.